if institutions have capital to invest, they need to have conviction. And this year we saw market conviction tick up a bit, and that to us indicates that institutions are increasingly ready to deploy capital and viewing the next couple of years as potentially good vintages, which is what we hear over and over from institutions.
Hello and welcome to the REIT Report. I'm your host, Sarah Borgson-Keto. My guest today is Doug Weill, founder and co-managing partner at Hodes Weill and Associates. Doug is joining me to discuss the findings of the 13th Annual Institutional Real Estate Allocations Monitor, which Hodes Weill publishes in conjunction with Cornell University's Baker Program in Real Estate. The Allocations Monitor is a comprehensive annual assessment of institutions' allocations to and objectives in real estate investments. Doug, thanks for coming back on the podcast.
Thank you, Sarah. Nice to join you on the podcast, and also want to thank NAREIT for your continued support of the Allocations Monitor.
Great. So after 2 years of target allocations to real estate holding steady, the 2025 Allocations Monitor shows that institutional investors have decreased their commitment. What does that really signify?
It's not totally surprising to us that allocations dipped a bit. It was modest. It was about 10 basis points. That was what was anticipated when we published last year's report. This does follow pretty strong growth in allocations over about a 10-year period, where allocations grew just over 20% and then plateaued, and then we saw a slight dip this year. Importantly, as we look forward, institutions are anticipating that they are going to begin to grow their allocations again, and the projection is about 10 basis points over the next 12 months.
That sounds fairly positive. Would you agree?
I think so. Our view is that institutions are not stepping back from real estate as an important allocation in their portfolios. They're just lightening up a bit. And in some cases, the allocations are being shifted over to both infrastructure and private credit, is what we've seen.
And how would you describe institutional investor appetite for risk, and how is that shaping allocation decisions?
Yeah, this was a really interesting finding this year. We had seen interest in core strategies really declining year over year for the past couple of years. And this year, we have seen a meaningful increase in appetite for core and core plus. I think this bodes well for REITs in particular, because REITs for many institutions are a good substitute or a good way to allocate to core and core plus.
What are you seeing in terms of geographic dispersion of real estate allocations? And would you say that the US has seen any real impact yet from tariff volatility and other market uncertainty?
It's really dependent on the type and size of institution in addition to location. We've seen more of a pullback out of Asia, and the US has been largely flat year over year. I think, again, institutions are maintaining their commitment to real estate overall, and this is just a slight tactical shift.
And what are you seeing, Doug, regarding the overall level of institutional allocations to REITs? And what's driving those decisions to allocate to the sector?
Yeah, we're seeing about 1 in 3 institutions are actively allocating to REITs. And when we ask them about what it is about REITs that is most appealing, the two main or top objectives are liquidity and a proxy for core. Liquidity has been increasingly important to institutions across their real estate portfolios because they've seen very limited distributions from their portfolio managers, particularly in closed-end funds where distributions have fallen off. And that correlates with a cyclical low in transaction volume. So if managers aren't selling their assets, they aren't returning capital. So as an institution often needs to rebalance their portfolios, liquidity is very important. Not surprising that liquidity is a very important objective for institutions, and hence we think is driving more capital to REITs.
Are there any noticeable trends in terms of the size and the types of institutional investors that are allocating to REITs?
Yes, we tend to see larger institutions more actively allocating to REITs. So that would be, by example, some of the larger cap public pensions and also the sovereign wealth funds, which are generally offshore. And in both cases, they seem to be pretty active in allocating to REITs. And many of them also manage their portfolios in-house. In other words, they don't always use a third-party manager. They have dedicated teams that help them allocate to REITs.
As institutions invest in REITs today, are they doing so out of their REIT or public equity allocations?
Yeah, generally, we have seen that institutions that are active in REITs are including that or allocating out of their real estate allocation as opposed to out of their public equity allocations. So it's about 90% of institutions that are active in REITs are doing that through their real estate allocation. That doesn't mean they don't have some allocation to REITs through their public equity portfolios, maybe through indices or diversified portfolios, but in terms of dedicated, actively managed REIT allocations or REIT programs, we tend to see that coming out of the real estate allocation and therefore managed by the real estate teams at these pensions and sovereigns and so on.
Why does that distinction matter?
I think it matters because increasingly we're seeing institutions look at public and private means of investing in real estate as complementary and REITs again as a good way to access core and core plus strategies and also certain sectors that may be hard to access on a private basis. So increasingly institutions seem to approach in public equity investing alongside their private allocations.
What are some other notable trends or developments that the 2025 Allocations Monitor is highlighting?
I would say two things. While target allocations went down, albeit slightly at 10 basis points, a very important measure of liquidity is actual allocations against target allocations. And today, institutions are about 90 basis points underallocated. And that's a pretty wide margin. It matches about the 10-year average. And the last time that we saw target allocations or the delta between actual and target gap out this much was 2021. And what followed was a period of time where the industry saw a lot of liquidity, transaction volumes, fundraisings peaked, and we just saw capital flows really accelerate. So that in combination with market sentiment, which is also important. If institutions have capital to invest, they need to have conviction. And this year we saw market conviction tick up a bit. And that to us indicates that institutions are increasingly ready to deploy capital and viewing the next couple of years as potentially good vintages, which is what we hear over and over from institutions.
And are there any particular sectors that you think will be most in demand in the next year or so?
We continue to see a few themes in the market. Industrial, particularly on the private side and private funds, is a preferred investment allocation. We are seeing interest return to multifamily strategies and then other niche strategies, including all things storage, including self-storage and other specialty strategies. And then data centers, whether institutions view data centers as real estate or infrastructure, it's commanding a lot of attention. And then some strategies that had been out of favor for some time, including retail, seem to be increasingly in favor. So it's a pretty dynamic market. The other thing I would mention is that with the increase in core and core plus appetite, we expect you'll see allocations to those types of strategies increase year over year.
Finally, Doug, as you look to 26 and beyond, are there any other priorities or issues that you expect institutional investors to be considering as they look at their allocations to real estate?
Yes, I think institutions are beginning to look at real estate investments on a global basis again. We had seen for a couple of years that institutions were decelerating their cross-border or cross-regional allocations. So, for example, Europeans coming into the US or Asia-based institutions coming into the US or vice versa. And we are seeing that pullback seems to be reversing. At the same time, we are hearing from institutions, particularly out of Canada and to a certain extent Europe, that they are less likely to deploy capital in the near term to the US, given concerns about geopolitical risk. That said, the US continues to be the primary destination for global capital flows, and we think it's a market, given its scale and liquidity and historical performance, that global institutions are going to have to pay attention to over the medium term. So maybe in the near term, you'll see a bit of a pullback, but we think this is a short-term reaction to some of the dynamics that we're seeing in the market. But that's a trend worth noting and following.
Excellent. Thanks so much for checking in with us today.
Thank you, Sarah. I appreciate it again.
And to our listeners, if you enjoyed this episode of the REIT Report, please subscribe on your favorite podcast platform.